Welcome back to the Eric Krown Crypto channel, and continuing with the options playlist series, today we will be going over Vega, which is maybe one of the most important Greeks, especially if you're a volatility trader. And what essentially is it? Well, it tells you how your P&L moves if the implied volatility of the option that you are either holding or selling changes. So first and foremost, where do you find it on the good old bingo board here? Well, it's under the position screen, and we have Vega right here. So if I had a position on, it would give me some sort of read there that lets me know how to interpret that change in implied volatility. I think it would also be useful to go over here into the Greek's definition on good old Investopedia and just read it straight off the board. Vega represents the rate of change between an option's value and the underlying asset's implied volatility. This is the option's sensitivity to volatility. Vega indicates the amount an option's price changes given a 1% change in implied volatility. For example, an option with the Vega of spot 10 indicates the option's value is expected to change by 10 cents if the implied volatility changes by 1%. Because increased volatility implies that the underlying instrument is more likely to experience extreme values, a rise in volatility will correspondingly increase the value of an option. Conversely, a decrease in volatility will negatively affect the value of the option. Vega is at its maximum for at-the-money options that have longer times until expiration. Okay, so how do you interpret this? Well, first and foremost, this is why I put so much weight on indicators like the BBWP indicator that we have here, simply because it tells you when volatility is generally low or generally high, and whether it would be a better idea to be either long volatility or short volatility. And I use volatility and Vega interchangeably here, just for reference. So when volatility is very, very low like this, I actually want to be buying low volatility contracts because they're more likely to rise, seeing as volatility is set to expand here as it's gone fully contracted. So if we go back into the options bingo board, how can we interpret this? Or actually, let's go over here, and how can we interpret this in a more practical manner? Well, again, for every $1 change, or sorry, for every 1% change in implied volatility, that is going to equate to a P&L change. So if we have a Vega of 1, meaning that we're long 1 Vega, for every 1% change in implied volatility, the price of the option will increase. If implied volatility goes up 1%, then the price of the option contract will change by $1 to our benefit. By contrast, if there is a 1% decrease in implied volatility, meaning that volatility is going down, typically happens during consolidations, then that option contract will be worth a little bit less. And therefore, if we were long that option contract, we would lose $1 in this particular scenario here. There's really not much more to it other than that, although it is perhaps one of the most important ones. That alongside Delta is probably the most important one from my own personal understanding. But in general, Vega, we want to be long volatility, generally speaking, when implied volatility is low or relatively low. We get relatively low reads or understand relatively low reads by looking at volatility indicators like this, like the BBWP. We also have the HVP of stochastic volatility. There's plenty of ways to do this, and they all kind of, they should all kind of print about the same results anyways. But in this case, we want to be long volatility. We want to be long Vega. When we get low reads like this, it's more likely to expand. And if it's more likely to expand, then that means for every 1% change in implied volatility will equate to, well, higher P&L for us, depending upon how many, how long we are Vega right there. By contrast, selling options will get you short Vega, meaning that you'll have negative theta. And that means when price action continues to range and consolidate, and of course, implied volatility collapses, well, we start to make money. And by contrast, if price action starts to really move, starts to trend, starts to break out, an expansive move essentially, implied volatility will go up and we start to lose on that contract. So again, if you are long Vega, you bought an option and you want price action to generally just move a lot, that is what essentially makes that option contract more valuable. And by contrast, if we sold an option, then we're going to be short Vega, meaning that we generally want things to range. And we don't want to see major massive moves, because if we see major massive moves, then that means that the price of that options contract will go up with everything else, if everything else were staying still, which it doesn't, obviously. For example, if we sold a $22,000 call strike and price action right now is trading below that region, well, price action can go down as far as it wants. It's not going to make the options contract more valuable in this case, obviously. So this is a lot more useful when you're trading multiple different legs, between different strikes and between calls and puts. That's where understanding your Vega risk is quite important. So I will leave this one there, and I will see you in the next one. Take care.